Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, July 21st, and I'm recording this from the studio in Purchase, New York. U.S. equity markets continue to celebrate economic resilience, setting new highs amid benign levels of volatility, all despite resurgent tariff policy uncertainty. This suggests to us that equity investors have moved on from concerns about how tariffs will impact growth and inflation. Such optimism, which is in contrast with the bond market, where Treasury yields have backed up, seems to be driven by a combination of beliefs, namely that tariff proclamations are just negotiating starting points, that legal challenges could render certain deals moot, and that inflation pass-throughs will be modest, and that any hit to corporate margins will ultimately be offset by productivity-related gains. We do recognize that the economy has been more resilient than previously forecast. GDP growth for the second quarter is estimated at 2.4%, and recent inflation data came in as expected, while corporate earnings are likely to beat lowered estimates. Still, we think it's premature to completely shrug off these trade-related risks. For one thing, only 3 country-based deals have actually been settled, with Vietnam, Indonesia, and the UK, and the most significant changes to policy still coming. Uncertainty remains when it comes to our largest trading partners like China, Canada, Mexico, and the EU, while impacts on commodities, semiconductors, and pharmaceuticals still lie ahead. Next, we see inflationary pressures gaining. We understand that tariff impacts have been obscured by shifting implementation schedules, anticipatory inventory building, and trans-shipping strategies. That said, when we consider the actual data, our read is more cautious than the equity investor consensus. Consider that June CPI data was largely viewed as in line with expectations, but a closer look actually shows rising price pressures. Excluding autos, core goods prices jumped 0.5% in June, its fastest move in 3 years. Analysts at Pantheon Macro reported that price hikes on China-linked imports like appliances, toys, electronics rose about 2% in the month. They note that tariff costs are also showing up in food prices, with fruit, beef, and vegetables up more than 1%. Additionally, even as discretionary services are seeing some demand destruction, supercore services inflation is now running hotter. Also critical to our read on inflation is the weakening U.S. dollar, which has reduced American purchasing power on imports by 8% since January. Finally, we sense that equity investors are too complacent on where tariffs could ultimately end up, especially if the administration is emboldened by stock market resilience. Consider that 2 of the 3 deals announced so far, 19% for Indonesia and 20% for Vietnam, suggest that tariffs could move well beyond the estimated 13% effective rate. For both countries, transshipments from China would be taxed at an incremental rate of 30%, totaling at an extraordinary 49 to 50%. This is critical for items like apparel and housewares. The 50% threat on Brazil is also noteworthy and would impact key commodities like coffee. So in short, the coast is not clear, and at this time we encourage discernment and stock picking rather than momentum chasing. Investors should consider stocks with potential for upside surprise in earnings and cash flow. Among them, select tech names and others in financials, industrials, energy, and parts of healthcare that are policy beneficiaries. Avoid some of the overhyped themes and complement with diversifying positions in international equities, commodities, energy infrastructure, and hedge funds. As always, thank you for listening, and for more information on portfolio strategies and financial planning, always reach out to your Morgan Stanley financial advisor.